Hi, I'm Greg Everett, Deputy CEO at First Super, and welcome to our mid-year investment update. I'm here with First Super CEO Bill Watson, who will be looking back on how the fund has performed over the last 6 months. Welcome, Bill.
Thank you, Greg.
To start, could you tell us about First Super's investment performance so far this financial year?
Be my pleasure, Greg. So far this financial year, all of our investment options have delivered returns above their performance objectives. This is encouraging news for members. Our balanced option returned 4.53% for super members and 4.82% for retirement members. This builds on the 9% return for accumulation members for the last financial year. These are strong short-term results, but it's important to remember that super is a long-term investment. Performance is best judged over longer time frames, not just a few months.
Thanks, Bill. They are good returns. Looking at the last 6 months, what were the most significant contributors to investment performance?
So over the last 6 months, we've continued to see strong returns in infrastructure and international equities. This has been supported by continuing solid returns from Australian term deposits. Australian property, on the other hand, did not significantly contribute, but with investor confidence building and increasing international institutional interest in Australian assets, we've finally seen positive returns. But more importantly, we've got greater confidence that property will not be the drag on performance that we've seen over the last 4 or so years. In the first half of this financial year, Australian shares have underperformed global shares, and more particularly US shares. The US S&P index returned just over 10% for this period, whereas the ASX 100 returned 2.49%, so quite a difference. Global equities returned 8.85%. As in previous periods, what drove this return was US returns. They represent over 70% of this index. So while other developed market shares performed well relative to Australian shares, they did not perform nearly as well as the US. But what was really interesting in this period was the broadening of the US share market returns. The AI rally, which contributed so much in 2024-25, broadened. Investors sought out other companies that are either benefiting from or likely to benefit from the AI-driven capital expenditure. Industrials performed well. In all, the majority of US S&P sectors delivered strong returns. In Europe, returns for the 6-month period were also very strong, with some markets outpacing US returns. Some of this was attributable to weakness in the US dollar. The UK's performance in this period was outstanding. However, the performance of European markets in the second half of 2025 was nowhere near as strong as it was in the first half. Bonds continued to perform in line with expectations, and our credit funds investments performed well above benchmarks. In summary, despite the US Fed not bowing to political pressure to aggressively cut interest rates, persistent inflation and softening consumer demand, the US share market powered along, again making an outsized contribution to investment returns. Other developed markets and infrastructure also supported solid returns.
Thanks, Bill. And looking ahead, what is the investment outlook for the rest of the financial year, and what should members keep in mind when it comes to their super?
Looking forward, we expect developed share markets to continue to perform above long-term averages. Notwithstanding persistent inflation and patchy consumer demand, the US share market is likely to continue to be supported by the AI investment arms race. As we enter later into this investment cycle, we can expect greater volatility as we see signs of winners and investors being disappointed with the gap between substantial investment and insubstantial returns. Late in 2025, we implemented a new strategic asset allocation for our Shares Plus, Growth, Balanced or MySuper and Conservative Balanced investment options. The most important change was increasing exposure to growth assets, that is shares. We've taken the view that international shares will continue to outperform Australian shares. As a consequence, we've increased exposure to international shares rather than Australian shares. There are likely to be further interest rate cuts in the US, but more likely later in the year. This will further support investor confidence and help the rally to continue. But you'd have to be brave to forecast the magnitude and the velocity of the cuts the US administration is pursuing. Inflation is still persistent in the US as it is in Australia. In other developing countries, this isn't so much of an issue. However, weak consumer demand in Europe, the UK and Japan is. Persistent inflation creates interest rate risk and bond volatility. Weak consumer demand means that consumer-dependent companies could disappoint shareholders with depressed earnings or earnings that don't meet market expectations. The precious metals rally appears to have run out of steam with the nomination of Kevin Warsh as the next chair of the Federal Reserve. Warsh's nomination has been welcomed by markets, providing certainty and stability that the gold bugs weren't betting against. The precious metals rally rolling off will impact Australian miners, some of which have had a terrific run recently. Recent weakness in the US dollar is likely to continue, so this will impact returns as a fall in the US dollars buys less Australian dollars. Geopolitics still looms over the markets, but as in previous periods, events don't seem to impact share markets in the way that we anticipate. In a nutshell, for the remainder of this financial year, we expect, but can't guarantee, more of the same. As Columbo would say, just one more thing. From 1 July 2026, Payday Super starts, and this is a great thing for our members. Put simply, it means that everyone's super will be paid on their payday, instead of some members' super being paid every quarter. Some members may already see their super being paid in this way, so you might not notice a change. But for others, it means your super should be paid more often. Over time, with investment returns, this means more money for your retirement. If you'd like the details, including what it means for employers, the latest updates are on our website.
Thanks, Bill. Payday Super sure is a great change for members. Finally, if members have questions about their investments or their account, what's the best way to get in touch?
If you have any questions about your investments or your account more generally, or just about First Super, the best thing to do is contact us. You can call or email our member services team and they'll help you work through the queries. If you'd like more tailored guidance, that is personal advice, you can speak to one of our financial advisors. There's no additional cost to discuss your First Super investments with an expert. And of course, you can keep your eye on your account and your investment options through the First Super app. So I'd like to thank you very much for being members of First Super. We appreciate looking after your retirement savings.
Thank you, Bill. And thank you for watching. We hope to see you at our next investment update.